Hey, welcome back to another Southwest Florida housing market update. I'm seeing some really big shifts in the market down here in Lee County and Collier County this week. So we're going to dive right into the analytics database live so I can walk you right through everything as I do it. And I'll give you my opinion on what the data is showing us and what that means for the future of the housing market. So that's all coming up right now. So let's get started. So before we even get into the stats for Lee County this week, as we usually do, I just wanted to point out a couple data points that are really significant here. First one is the new listings right here at 1352. You can see the green bar kind of gives an indication as to where historical trends are. So we're not really that high, but with price decreases 2408, that's pretty high. And you've probably seen headlines on YouTube and social media and the news outlets, mainstream media that are showing that there's tons of price decreases. I know YouTube headlines are all about, housing crash incoming or it's happening or whatever those headlines are. So although this data is showing this, I do want to get right into the analytics directly from our MLS because as many of you probably know, real estate is hyper local. So what's going on in one market is probably not going to be happening the same in another market, even city by city, even community by community. So we're going to go right into those analytics right now, and we're starting off with Lee County. First up is weekly, the median sales trends. This is the weekly changes, and it also displays the year over year. So over here on the right, you can see 416,000 is the current week that's ending as of 3/2. And then prior week, we were at 429. So this number, median sales price, is actually down 3.2%. 3.2% is really not that much considering over the last 3 years, we've seen over 100% increase in the actual home prices. Now, when you look at it same week prior year, it's down 7.5%. Closed sales, 346. So closed sales is lagging indicator that these are homes that went under contract 30 to 45 days ago and have now finally closed. From 215 last week to 346 this week, that's a 60% increase. So you can see about a month ago when interest rates started to come down a bit, people entered the market, buyers entered the market. Why wouldn't they? They're trying to get the best rates that they possibly can. And in every market, people need to move. Not everybody does have the ability to wait. People move for jobs. They have families that are growing and they need more space. So people are always buying and selling in any market, really. Again, same prior year. It's down 3.1% from prior year closed sales. Now let's look at the new pending sales because new pending sales is what is actually happening in the market right now. Now we're at 408 this week. But last week we were at 374. So pending sales are also up almost 9%, almost 10% up. And you can see new pending sales have been declining all the way up to about December. And now we're back up here to 408. So new pending sales increasing. And then we have closed sales also increasing. Let's see what is actually going on with inventory. So active inventory over the year is obviously up 66.55. But that's actually down 1% from last week. It's up 70% from last year, right? At the same time. That sounds really bad. But before we get into that, let's look at what is the historical averages for active inventory. So this is for Lee County. Going back to 2017, we were at 16,735. That's in February, which was the peak of that year. And then it declined. And then we go back up here, and this is also February at the peak, 16,870. Now we go back to 2019, right before everything happened. Are we back there yet? Nope, we're at 15,000. So we're still below the averages for February, historically speaking, compared to obviously the last 3 years, you had this huge dip, but we're not even back to all-time historical averages for inventory in February. So this is showing you that although those headlines may be saying inventory is exploding, yes, it is compared to the last 3 years, but historically compared, we're still below average for inventory. Now let's head back here, active inventory. What's going on with new listings? We saw that pending sales are up, closed sales are up. That means people are buying. So with that happening, what's going on with new listings? Are there a lot more coming on? As you can see, no, we don't have that much more inventory coming on. It's actually down some from back in beginning of February. We've gone down. But yeah, of course, over the last 3 years, it looks great. But now when we look at the historical averages, again, back to 2017, in January, we had the most amount there. That was 5,290. Same thing. January of 2018, 5,773. Next year, same thing in January. And you can see that all these spikes are in January. And that's because a lot of agents, when they list the homes, they usually make their contract up until December 31st of that year. Now, when that happens and all those homes go expired on the 31st, January 1st, they relist. So you see a ton of new inventory, new listings come on the market. And that's exactly what we saw here. January 1st, we're at the peak. And already by February, we're back down 520, 52, 54. Compared historically, no, we're not seeing anything crazy with new listings coming on the market. Now moving on to Collier County, which is a little bit of a different market. You know, prices than Collier County, Naples area, Marco Island, prices for homes are a lot more expensive down there. So these numbers are going to be quite a bit higher. Median sales price, $1,050,000 for this week, actually up 21%. So you can see there's still obviously still demand if prices are still rising for the median sales price. Now that's different from the median asking price. Median sales price means this is what homes are selling for. So if the increasing of, you know, week over week and year over year, we're up 21% year over year as well. That shows that there's still a lot of demand for for Collier County. Closed sales, same story here, up 46% from last week. That's up to 117 from 80. It's down though 10% from last year, 130. So that's a little bit of a different story here from Lee County to Collier County. New pending sales went from 122 last week to 148. That's up 21.3%. It's also up 24% from last year at the same time. And then here we are again with active inventory. It looks like it's really high compared to everything else. This is only a 1-year chart. So we're at 2657. That's up 0.1% from last week, 38% from last year. So that's huge, right? And then if you compare that to over the last 2 or 3 years, it's probably closer to 100%. Let's take a look at the monthly to see where we're at. Same thing. This looks a lot higher because it is a lot higher than 2020. But compared historically, you know, this is February. Back in 2017, February was the peak, 16,735. So we're not, you know, we still got another 1,000 to go from there. 2018, pretty close to the same number. 2019, we actually had a new all-time high, 18,000. So we're, you know, 3,000 away from that. So again, you know, yeah, this is a huge increase in supply from 2022, 2021. But historically speaking, we're not seeing anything crazy here. Now let's go to new listings. New listings, 2011, that's up 21% from last week. So that's, you know, that's obviously a large increase, 21% week over week, also up 30% from last year. So what are we looking at on the monthly standards? All right, yeah, we're at 5,254 for February. Peak here was again in January, new listings coming on that expired. So we see a peak here, 5,588, but compared to 2019, 5,689. So we're pretty close to where we were. Peak back in 2018, 5,773, 5,290. So, I mean, all of these historical peaks are actually, you know, a decent amount higher than where we're at currently, even for Collier County. So there's nothing crazy going on with the amount of new listings. Yeah, the headlines are great. It looks good compared to the last 2 years, but that's not what is actually happening. So make sure when you do your research, especially if you're doing it in a different city outside of what I'm covering right now, make sure you really home in on somebody who knows what the stats are and are really tracking it. And they're going through the historical data, not just what's happened last year. That doesn't make a difference when we're in a market that's not normal. Now, before we get into the last couple stories, I want to just go over how the monetary system works so you guys can understand why I don't think prices are going to crash like we saw in 2008, 2009, because the monetary system that we're in now is a debt-based system and it's based on a fiat currency. Fiat basically meaning it's not backed by anything. It's not backed by a commodity that is, you know, finite like gold or silver was back before the 70s. So with it not being backed, basically the Federal Reserve or governments can ask for a expanding supply of money. And the reason they're asking for that is because if you look at the population growth, we have about 1 million new births per year. We also have at least 1 million migrants moving into the United States every year. So that's a 2 million net surplus that we have of population. With that being the case, there needs to be an expansion of money supply. And that's why we have a 2% target rate. If we didn't need that expansion, there wouldn't be a 2% inflation rate as the target. It would be zero. We would just keep money the same all the time like it was with gold and silver. But because population has continually increased, there needs to be an expansion of money supply. When you expand the money supply, the value of the money supply that was already in existence before the expansion now goes down. It's called devaluation or depreciation of that fiat currency. So when people are getting upset about prices of homes increasing so much, it's not because the prices of homes have increased. It's just the fact that expansion of money supply has made that dollar worth less. So with trillions of dollars being printed in the last several years, we're looking at, you know, $1 trillion depreciation or devaluation of the dollar. So home prices go up, and that happens with all assets: gold, you know, silver, energy, real estate, food. All those things are things that people need and are always going to need because we just need them to survive. So with that being the case and the expansion of money supply and the population growth, assets are going to continually increase in price. Now, if there's an oversupply of something like we saw in 2007, 2008, that's when you see a crash. But crashes don't happen, over a couple months' time or even a year. They happen over several years, 5 years. Now, if you're waiting for a crash, I mean, you could look at right now with prices depreciating or going down slightly 3% as part of the crash, and that could take 5 years to unfold. Meanwhile, you're still going to be renting, you're still going to be paying that rent. And while you might be able to save some money in the rent and you might be able to put that savings into some kind of investment, for the most part, unless you're, one of the top 1% of the top 1% of hedge fund managers out there who knows how to get those kinds of gains. I mean, most hedge fund managers can't even outperform the S&P 500 every year. So the likelihood of you being able to put that savings into something that's going to appreciate enough to make up the difference of you not owning a home, for the most part, most people aren't going to be able to invest like that and make 20% gains. Now, if you invested in a house in 2018 when they first started saying there was going to be a crash, yeah, believe it or not, check the headlines on Google. There's a bunch of different headlines. 2018, people were calling for a crash in the real estate market. If you bought in 2018, like some of my clients did, they actually had what? They bought their house for $250,000. They ended up selling it for, unfortunately, $425,000 because they waited too long. When they originally were thinking about selling, they probably could have sold it for $485,000. So that's well over a $200,000, $230,000 appreciation of their home. And that's equity right in their pocket. That's not including what they've already put into equity, into the house that they get back. So if you can walk away with, close to $250,000, that's after closing costs and everything, I'd say real estate's probably one of the best places to put your money. But, things could come down. That's not, not to say that real estate is the best investment you can make. There's plenty of other ones in private equity. If you're, like I said, if you're an accredited investor, you might be able to get better returns. But real estate's a pretty good one. And unlike rents, where you literally all of your money goes to someone else to pay their mortgage, owning your home, yes, you're going to be paying taxes, you're going to be paying insurance costs that you'll never get back, but you're also going to be building equity. So at least you're getting something back. Now, it's definitely more affordable right now to rent than it is to buy. But you have to look at the long term. If you're planning to live in a place for at least 5 years right now, if you can comfortably afford the mortgage, which I know there's a lot of people that can't, and that's fine. And maybe renting is the best situation for you now. But if you can comfortably afford a home that you want, you can find the right home and you can get it at a decent price without a lot of competition right now. In my opinion, I would say, why wouldn't you? And that's exactly what I did. So I'm not telling you something I wouldn't do myself. I didn't want to buy a house at 6% interest rate, but I did. And I'm glad I did, because I couldn't stand renting. I couldn't stand being in my 2-bedroom, 1-bathroom, condo and paying every month. That was money that was just going out the window. It wasn't going back to me. It was just gone. So if you're in that situation, I feel you, I understand, and if you have questions, just reach out to me. I'm happy to help. So now let's look at the couple of stories. I know these are headlines. People talked about foreclosure activity, and it's way up, it's skyrocketing really quickly. And sure, it did back in the back in the third quarter of 2021 into the first and second quarter of 2022. Yeah, it did go up a decent amount. But that was when things were starting to end. People were starting to back into the swing of actually making their mortgage payments. Some people fell behind, and that's why we saw the foreclosure rates. But since then, you can see it's been pretty steady. We're not seeing any crazy amount of foreclosure filings go up, especially here in the state of Florida. They are up, but they're not up, any crazy amount. And you can see back in even 2005, when things were pretty good for the economy at that time, you can see we're still below that level. So we're not even back to the averages. And with everything that's been going on with stimulus in the government and the programs that they come up with, I don't see them allowing this to go back to where it was back in 2008. These next two stories are all about home builders in Florida. The reason I'm looking at the Florida home builders is because they are a pretty good indicator, and they have a lot of money. They're a pretty good indicator as to where they see the market going. And if they're willing to bet their large sums of money, especially after they saw what happened in 2008, and they're willing to put their money on the line and say, hey, look, we think the markets are going to improve. There's going to be more buyer demand in the future, and we need to start increasing the amount of homes that we're building. If that's the case, then I tend to follow the money. You know, if people are spending more money, I think that's probably where things are heading, especially if they have enough money to where they can be lobbying for politicians and things like that. So here we go. National Association of Home Builders, single family construction spending rises. It didn't rise a lot, but it's only up 0.2% in January, but it's up 12.5% year to year. So that gives you a pretty good indication. You know, they're willing to make a 12% bet on their money. And we're talking billions of dollars, hundreds of billions. So here we go, $900.8 billion, right? So with that kind of bet, I'm guessing that, you know, things are going to improve and they see things improving, you know, pretty soon in the next year. Also, right in line with that, Lennar Corp, which is one of the largest, you know, home builders in the United States, as well as Invitation Home CEOs, said that technology, single family rentals, and good partnerships can help address the housing shortage in Florida and across the US. But not in the way that we think. And this goes along with the theme that I've been kind of talking about for the last couple of months is we're heading what looks to be like we're heading towards what people have dubbed a renter nation. So these two builders are looking at build to rent models, which have been happening over the last several years and really the last decade. Build to rent models could make housing more attainable. So, and this is how they are pitching it, is that people who don't want to rent and people who aren't able to afford or buy a house, this is the middle ground that they've come up with. The typical journey is from an apartment style to single family lifestyle that is closer to parks and schools. But what Invitation has done to build that middle ground for people who are not ready to buy but want a single family lifestyle is they're building single family homes for rent. That's their business model. The company is expanding with a pipeline of around 1 billion or 1.5 billion across 10 markets. Florida is one of those markets where they have 25,000 single family homes and very active, mainly in Jacksonville, Orlando, and Miami. But I wouldn't be surprised if we start to see that happen down here in Fort Myers and even the Sarasota area. The hot spots, you know, Tampa, hot spots where people are really moving. All right, thanks for watching, guys. I know I went through a lot of information. I hope that data, the historical data specifically, helps you understand where we are compared to, you know, 2017 before all the craziness happened. Really, I think with the Fed rates probably going to be dropping towards the end of the year, I do think buyer demand is going to kick up quite a bit. Even the 1% from 7% to 6% interest rates, you can see we saw a lot of new pending sales, new closed sales. So those are both up. And I think that's only going to increase. I think a lot of people are just tired over the last 3 years of hearing about the crash that's supposed to be coming and all these foreclosures that are going to be, you know, hitting the market like a wave and all this stuff happening. So I think people are just tired of it. I know I am. Honestly, I don't even watch half those channels anymore because I'm watching the data right here locally and I'm seeing that what they're saying is not actually what's happening. I know insurance costs have been an issue. Those are starting to be resolved now too. Insurance companies are, you know, there's a lot of stuff going on with insurance companies that they are trying to figure this out for people. And I think Southwest Florida and even South Florida, Miami area, I think it's always going to be, you know, a hot spot. It's a destination for people to vacation. It's a destination where people want to have their second home. They want to have that beach lifestyle, that paradise feel with palm trees and sun all the time. You know, the quality of living is just different. You're outside all year round. You're not cooped up in cloudy, gray skies all year where you have seasonal depression. So I think this is going to be always going to be a great area. Whether or not prices come down really doesn't matter much if you plan to stay in a house for 5 years or more, because even if they do go down, you're probably going to recover it. But you know, there is always that slight chance that you don't. So just keep that in mind. Search hyperlocal, do your due diligence, make sure you're talking to somebody who knows what's going on in that specific community, city, or market. Thanks for watching, guys. I hope to see you in the next video, but until then, stay safe, stay positive, and more importantly, stay free.